You recognized?
Thank you, and I've got a little bit of a time constraint, so I appreciate the yielding the time. First of all, thank you for your testimony. A lot of very interesting questions have been raised. I happen to co-sponsor a bill along with bipartisan bill along with Senator Wyden that was really crafted by Senator Wyden and Senator Gregg over about a 3-year period of time. I got the baton handed off to me when Senator Gregg retired from service. I've worked with Senator Wyden tweaking some of the provisions of the plan. What we both said, what he said with Senator Gregg and what he and I are saying today is this is not the be-all and end-all of tax reform. These are some ideas and some thoughts based on some basic principles that have been vetted over about a 3-year period of time by a number of organizations, and we still leave the door wide open for suggestions for improvement or even major changes to it if we can find adequate substitutes that better lead us toward the goals that we all are trying to reach with tax reform. Clearly, there's a growing consensus that we need this reform and need it badly, and I'm hopeful that that consensus will lead to actual reform, and obviously we want to do it the right way. In the limitation of time, let me just focus on one aspect of the Wyden-Coates provision, and that is addressing the corporate tax rate, which was mentioned and was on the chart. We see that as a strong impediment to the competitiveness in a global economy. Difference of opinion as to how much of an impediment it is, but there's pretty much a consensus that we don't need to be at the top of the 36 OECD countries in tax rate. And that a much being at least at the average level would be a benefit to the United States. And so ours brings it down to 24, and we're looking for ways to actually bring it down to 21 or 22. And we do that by eliminating a lot of the exclusions, exemptions, subsidies, and so forth that, as has been said by the panel, some of the more effective lobbyists have been able to insert into the tax code through, well, actually the Congress did, but through some effective lobbying by some corporations than others. Now, I've met with and talked to a lot of heads of multinational companies, and almost exclusively, I've heard two things. One, well, our company doesn't have a problem with that because we've been able to use the X, Y, Z subsidies, credits, et cetera, and that brings our rate down to a level where we are competitive. And others say, you know, this is very unfair because those who have have been successful with the tax writing committees get a break at the expense of the others. And many have said to me, look, if you can get us down into the low to mid 20s, I don't care what exemptions I have or what breaks I'll take that over having to go through the process of continuing to work to save my subsidy, save my credit, save my exclusion, or get a new one or whatever. So I would just love to get rid of all that effort, all that time, all that cost, all that uncertainty. Just give me a rate where I'm competitive with my competitors. Any problems with that goal in mind? And if anybody of you have examined our particular legislation, any comments you could provide for us that would be helpful would be appreciated.
Senator, a good friend of mine, in fact, used to intern with us, was one of the staff people who worked with Senator Gregg on this bill. And I asked him as he was putting it together, are you checking the rate cuts versus the offsets? And joint tax was not providing decent information. In two areas, there is a problem with the bill. First, the increase in taxes on capital gains and dividends is not a good idea. Second, they really...
I happen to agree with that.
Okay. But
even though it's my own bill.
Joint tax gave you estimates and notions on depreciation that really were extraordinarily harmful and wrong. You have been put back to asset lives that Kennedy used, but not the double declining balance that he used. So you have the worst tax treatment on depreciation of capital since the Eisenhower administration. Some industries don't care about that. If you have nothing but, for example, royalties and software, perhaps without any big manufacturing costs, that won't bother you. you'd prefer a lower rate. But if you've got manufacturing equipment and other capital-intensive industries, that will cause a great deal of trouble. We tried to measure the relative effects of these changes, and in our model, it comes out very badly. One of the points that you need to note is that you will have, of course, in your bill, an elimination of the domestic production or manufacturing credit, which already lowers the corporate rate to some extent for those companies. And that means that the rate cut you're apparently giving isn't as big as it appears to be. So the depreciation then weighs very heavily against what is, in fact, not quite a big enough corporate rate cut. If you can get down to the very low 20s or 19 with that depreciation schedule, you might make up for it. But I think you're going to have a great deal of trouble getting a lower service price of capital in the structure that you have. I also think that if you have a revenue problem, keep the expensing or keep the depreciation allowances alive and valuable if you must raise revenue by switching to what you would call a neutral cost recovery system. Keep the longer asset lives, but pay an interest rate, a respectable one, like a long-term return on capital of about 3% plus inflation on the unused balances going forward. The present value would be the same as expensing, but it would give you enough time to get all the added capital into place before you actually had to have the bigger depreciation write-offs over time. The mismeasurement in the bill is causing it real problems. Now, there are many other subsidies to the corporate sector that can and should be closed to lower the rate, and in that general framework, I would agree. But when you have these specific provisions which hit at the service price of capital, and it doesn't come out quite right.
Well, thank you for that. I take that as a constructive suggestion. I guess what I would ask of you is that you have the individual who wrote that, who now works for you, issue a mea culpa and send me details of what you just have said, and we'll go to work on it.
He was an intern 20 years ago, but I'll get in touch with him again.
Your suggestion is very helpful. My time is up. Thanks.
Senator, thank